Welcome back to Market on Close. I'm Oliver Rennick. We got about 10 minutes until the end of the trading session. I want to bring in the closers panel. Scott Connor, Director of Trader Education at TD Ameritrade, is with us, as well as Nirav Batavia, Co-Managing Partner at Forum Financial. Welcome back, Nirav. As well as Charles Moon, Senior Market Strategist at Prosper Trading Academy. Glad to have you here, Charles.
Thank you for having me.
We've got Mr. Bauer here quite a bit, so nice to round out the team. Nirav, let's start off here because you were with us about 2 months ago, and a lot of the trends that worked for a long time, investors fell right back onto after the market volatility kind of eased. They went back to tech, back to growth. So, is it finally time? Is it finally time for a shift?
Well, the last week has been something else. I mean, after Netflix earnings, and we saw what happened after Facebook earnings. We basically have seen a big change between value and growth. Value was trailing growth by almost 13% if you used Russell 3000 indices about 8 days ago. Right now, it's only about 7.5% year to date. That's half of that has come back in a week.
Now, guys in control, bring up IWY minus IWX. I actually use the top 200 Russell growth versus value, but same idea. But Rob, we've heard this before many times, and it didn't pan out. So why do you think now is something different?
Well, we'll see what happens. What all of the major tech names have always said is, even if they miss earnings once, they won't miss twice in a row. So I think this has set up a lot of pressure for 3 months from now. And I'm not sure what happens between now and then, but I think now we're going to wait and see what happens a quarter from now.
Yeah, here's the chart that we're talking about there. You can see basically this just real quick sort of contraction that's happened, not really in terms of a massive jump in value, but strength there and weakness within the growth stuff. Scott, and I want to get Charles' take on the tech side of this in just a minute. Sure. Thematically, Scott, we talk about this just about every day here. This also happened for a moment in March. The difference then between now and then is what? I mean, do we have to wait for rates to basically hike and kind of punctuate this turn, this rotation?
I mean, that certainly is going to play into it, but I think getting back to your point is that it does feel a little different this time. And I think this is kind of gets back to a little bit how we wrapped up last week. When we were talking about FANG, we always used to group them into one group and just follow a number. Now it's becoming increasingly important that you look within FANG and say, all right, right now they're split. It's 50-50. We had Netflix down, Google up, Amazon up, and Facebook down. And one of the things we took away from last week is you've got to separate these FANGs a little bit because the ones that are getting hit now are subscribers and users, right? Those are the ones that got hit the hardest. The other ones who have something else behind their name and their revenue source seem to be doing okay. Now, all eyes turn to Apple this week because they're the tiebreaker, right? We're going to see how FANGs end up this quarter.
If you spell your FANG with two A's.
FANG. Yeah, well, I think typically those 5 are included in the group with the 2 A's. You're absolutely right. But you're absolutely right. It is a little bit changed this time because people are actually looking at there's a little bit of diversion within the sector itself. And this we hadn't really seen as pronounced as we're seeing it this time.
Charles, come in on this because I know you focus on, you said the large cap tech space. Right. Do you see anything from the way you view markets or trading that suggests something's breaking down abnormally?
Yeah, it's fear, really. It used to be that these vehicles were buy and not worry about it. Buy, it's going to go up. Buy, and maybe it'll triple in price in a year. And now we're starting to see that downside volatility and people are really just freaking out because they're buying at the highs and they're getting stuck, and then the downside pullbacks have been really substantial.
It's a pretty freaky chart right there.
Right, and you look at Facebook with the Cambridge scandal, and they drop all the way down to 150, and then of course they bounce back to new all-time highs, and that's kind of where they're at right now. They're still dealing with the fallout, but to me it's like I'm still going to see investors, I'm still going to see institutional traders wanting to buy these names because they do believe in these companies. And with Facebook, with Amazon, I believe in the growth. I don't believe in it as much as Netflix. I think Google's going to be steady. I think Google's about as steady as Microsoft in my opinion. But I think in terms of growth out of the FANG names, it's going to be in Facebook and Amazon.
How do you, from a technical standpoint, make sense, and bring it back up again, guys, that chart. How do you make sense of a company that loses 1/5 of its value in a day? Do all the charting things go out the window there?
Oh, yeah, volume is always going to be king no matter what, right? We could weigh it against certain technical levels that we've seen from recent historical values that when we see reactionary tails, when we see a lot of people basically looking at that same price level, but when sentiment quickly shifts and then panic comes in and fear comes in, it becomes emotional. It's not technical based trading. So for my advice towards investors when it gets to this, lay your hands off. Wait till it settles out. Wait till a bottom comes into play. And when the bottom is established, that's when your upside opportunity really does show itself.
Mm-hmm. And piggybacking off of that, I work in an advisory business, and over the last week, I don't see the fear there quite yet.
Really?
I've had clients.
Your phone's not ringing off the hook on Facebook?
They are, but they all want to buy.
Yeah.
And so the fear to get out isn't quite there.
Mm-hmm.
Yeah, I think that's very interesting because we basically had an environment where buying the dip worked on these companies, and then to your point earlier about the sort of 3-month horizon, has Facebook, in essence, not to make a Facebook expert, but just sort of the market logic here. When Facebook says, here's our depressed expectation for the next year, is that bar getting dropped?
Well, my clients would say no. The street would say yeah. I will see how that shakes out over the next 3 months.
Yeah.
Well, this gets back to that whole thing about these two, particularly Netflix today, down almost another 6%, right? Again, subscribers and users, that's the growth. Now, if suddenly that formula gets turned upside down, or there's some doubt thrown in the picture, which we heard from Zuckerberg and Facebook this time. Again, that's why people have come back to buy these things, because they think, well, listen, okay, so there's a temporary dip, but growers and users are growing and growing and growing. Suddenly, the reason this feels a little different is because now we're talking about bigger issues. We're talking about social issues. We're talking about content and free speech and how is this all going to work out. These are long-time issues that Facebook's going to have to work through. And if they don't, or if they stumble, then what about the users and membership? That's when the picture starts to change a little bit. So I think that's why we're seeing a little bit more fear, and we're seeing more than just one day. We're getting a couple days of shakeout in these particular things.
Well, Scott, to your point, Netflix here is now lower than it was after its own earnings drop, where this Facebook event is the market in some degree is basically taking a vote that it's as important to some of the other names within this group as their own earnings were. Charles, when you are used to trading a group that did something for so long, how do you then navigate this in terms of either how you get exposure to it? Do you hedge more? Do you take different types of positions? Do you come in the market and play it different ways?
Yeah, so this really comes, a line gets drawn here. This is trader versus investments, right, or being an investor. And so when you look at the trading opportunity, to me, it's to the downside. You're trying to play in that momentum. And I think that's kind of where the major difference in terms of the landscape of the markets for me, besides the political and fundamental events, it's more that short sellers are taking a lot more control in some of the most bullish names out there. And that we're seeing in 2018 that sellers are getting very aggressive. Before they would get aggressive and they'd just get run over and they'd have to peel out of their position, and then all of a sudden the market, has a short covering pop again. And I just feel that in this instance, everything is designated to be short term. We're looking at opportunities. And if Facebook is, retracting at its biggest loss it's ever had, and it's just huge downside slides, and the trend when you look at a 5-minute chart, 10-minute chart, an hourly chart, and it's basically just red candles and it's just all straight down. It's really hard to try and buy into that, especially if you're as a short-term trader. You're trying to ride that momentum and trying to squeeze out as much as possible. So I think that's the biggest difference in this instance.
And for a long time, that market basically didn't exist because there wasn't that volatility. We're going to talk about that and some more in just a moment. We're going to take a short break. We've got about a minute and a half until the closing bell. We'll be right back on the TD Amertirade Network. Bring back our market closers panels. We talk some macro. Mixed in with the micro, Scott Connor, Director of Trader Education, is back. Nirav Batavia, Co-Managing Partner at Forum Financial, and Charles Moon, Senior Market Strategist of Equities at Prosper Trading. So we were just talking about the tech stuff, but Nirav, one of the big things we've been hitting here just the past week, and I think it's a big combination of macro and the small company trades, because you've basically seen on the company level this shift, and then the backdrop is overall market dispersion. Central banks now potentially going back to a type of January situation where they see economic strength. Does that set the stage for something bigger, a bigger rotational shift in your mind?
We'll have to see. What's interesting is banks have done extremely well in the last week or so, especially relative to the tech names in the market in general. And one of the things that happened that I thought was underplayed somewhat, but very interesting was when Trump talked about Powell and talked about how much he didn't like the Fed rate hikes. The initial reaction from the street was, well, Fed will need to assert its independence because this is unprecedented and this might make the Fed more aggressive. Well, what you've seen from the rate space is that they've priced in 2 hikes for September and December, but they're easing back on the hiking pace in 2019, and you've actually seen the curve get steeper. Well, that's good for banks.
Okay.
So we'll see how this economic and political environment kind of plays into some of these value themes.
It's interesting that the president's tweet is on your timeline for what's happened with rates, and I mean that very literally. That not only is it an interesting conversation on a big scale, of course, about his role and all that,
right,
but in your mind, then, is that potentially lessening sort of that flagging because of the short end here, that maybe he just wants to let some of the inflationary stuff ride?
It may be that, but you also have to remember that in some ways the executive and their policies do affect the rate and the shape of the curve, because now we have a much larger deficit to deal with because, in part because of the tax cuts and so forth. And they have power over issuance. And there is some belief in the markets that they're going to skew that issuance to the longer part of the curve.
Okay.
And try to steepen the curve using their own policy. So could this be a way of them telegraphing, look, we want the short end of the curve to stay where it is, steepen out this curve, make this kind of a better environment for banks and a number of the other companies in the U.S.?
Yeah.
We'll have to see.
I can follow that logic. One last point here I want to ask about, Nirav. But does it not require more assumptions than just saying, all right, for the first time in 3 months, Euro data is looking pretty solid. Even EM data is surprising to the upside. Now maybe we finally have a macro environment where that long bond curve can kind of be de-anchored in the sense of, the Bank of England comes out hawkish, BOJ comes out hawkish?
I would agree with that, except what we've seen is inflation expectations, if you look at tips, break-evens, and so forth, actually come down in the last 2 weeks. And that's where it just doesn't jive with the rest of that.
That's interesting, yeah. We were actually looking at some of the short versus long-term bond stuff, SHYG versus HYG, and you don't really see that duration playing out in terms of the market reacting. So I think that's a point well made. Charles, from the bank side that we just mentioned, what do you see in the trading activity right now? Because all of a sudden it was like the market decided after 12 months of people waiting for banks to perform that, all right, now's the time, guys, let's get in on this.
Yeah, the tape's been pretty healthy over the last month, but most notably the last 2 weeks. And, it just seems like any downside pressure, they've been able to at least withstand some of it. It's not saying that they can't have any pullback days. They've had pullback days, but it's clearly not as severe as tech. And maybe it's just money cycling from one sector to another. And we're starting to see a lot of the money come in. Maybe it's the retail side, institutional side. A lot of the volume filters that I do use is designed not to pick up retail sales, but people that are putting on actual size, putting risk on. And when I see risk on, especially in banks, especially ahead of FOMC events or meetings or such, it kind of it lends to me that they know something or they're speculating something more so that we're not seeing as of yet. And I'm always going to follow the tape. The tape is never going to lie. As much as people try to hide whatever their positions are or however they're trying to build up their positions, when I see the tape go green and heavy green, especially in downside markets, it really does scream.
So you're talking about upside moves that are confirmed by volume. That's the not lie. That's the honesty part you're talking about.
Yes.
Not the direction, but the conviction.
Sure, absolutely. Volume is always going to be king no matter what. It's always been that way. And tape reading's been around since pretty much the advent of the market, so that's always going to be important for me.
Where do you see that crop up? Are there specific names? Are there specific parts of it? Is it the Wall Street firms or some of the big insurance companies who can ride a widening yield curve if that happens? Because it also is basically lining up with the report a couple weeks ago that a lot of folks covered about institutions basically kind of shifting their growth positioning by some measurements on futures contracts and stuff.
Yeah, Citibank is one of the biggest names, Bank of America. I've seen a lot of buying going into JP Morgan and Morgan Stanley, but Citibank's been the healthiest by far. One of my colleagues at my office actually ended up taking a swing play and did pretty darn well in it. But BAC is another name I'm seeing a lot of money coming into. In the most recent, Fed stress test, they were one of the strongest out there. So I like the name. I like the upside. To me, if you want actual strong yield, you're going to be looking at the names like J.P. Morgan, like Citibank, that historically over the last 2 years have shown some really tremendous upside gains. So,
Scott, has this just been a matter of time for financials?
Yeah, it has, but I think there's, like, if you put everything together that just was outlined here, I think it kind of makes a strong case for why this sector is seeing some upward momentum right now. Number one, we had earnings already. They kicked off the season. It was okay. I mean, there were some numbers, there's some questions about maybe trading revenue and things, but overall good. Number two, if you do feel that the yield curve is going to be steepening a little bit, like you just mentioned, good thing. Rates up over in general are good, but a steepening curve on top of that is like icing on the cake, right? So
for those banks.
For those banks, exactly. And then third, if we're seeing people moving a little bit out of the sectors that have been in favor, or particularly like the NASDAQ and the Russell, they're looking to go somewhere with this cash, right? Where are you going to go right now? I mean, obviously, energy's been one that's gotten a lot of attention, but banks are one, particularly if you're looking for this steepening curve and a continued upward trend in rates. It could make for a compelling story.
Yeah. Nirav, what I think is so fascinating about this is these are really, even though we're talking about this from two different sides, the trading and the technical side versus this kind of macro interpretation, it comes together because banks didn't get any upside when we broke through 3 to 3-1. There were a few days there, but the market was basically saying either whatever reason we're still on the tech thing or we don't buy the move higher in yields. If this is different, then why? Because now we're just getting a little bit of an inch in 10 years. We're at 2.9 where we've been before. Why the conviction behind this? Does it have to speak towards a sort of institutional, again, to use this term of rotation?
And what it brings to my attention is Mohammed Al-Arian said today that the U.S. is the only country and only market that has escaped the new normal. Well, what's interesting is the data is getting better in EM. The data is getting better in Europe. And what we've seen in the U.S. is basically 10 years of consumer and corporate deleveraging that seems to be coming to an end. So could this be an additional expansion cycle where banks can finally take advantage where they really haven't had one for the past 8 years?
An additional expansion cycle. That sounds like we're getting bullish in the deepest part of the bull market.
But when are banks going to do well? When they can make loans, when they can, when the economy is chugging along, when the global economy is chugging along, and it seems that we never actually, for a lot of the world, they never got out of the 2008, 2010 recession.
Sure.
And it seems like we might have. And I should come up with a better term for this, but green shoots in some of those markets.
Well, I think it's pretty interesting because we actually started off the top of the show and a kind of related point, which is I think one of the most undercovered events of our market was that period from 2015 to 2016 where we had two deep corrections and about 300 companies went into bear markets, which is a pretty substantial chunk of the S&P. Basically the same amount, a little bit more happened in 2011, which by whatever technical measurement wasn't technically a bear market, but it was a deep, roughly 20% correction. Do you see, though, from your perspective, Nirav, enough juice after the tax reform or lingering consumer strength to power a longer-term move?
It's hard to predict because what we're basically saying is, yes, there seems to have been some juice from the tax cut or what's happening economically. I mean, look year over year, just at U.S. earnings.
Right.
I mean, we're looking at 30% year over year growth, almost, whether you're looking at operating earnings or as reported earnings, which is phenomenal. Now, that's obviously backwards looking, not what the market is reacting to at this point in time, but there seems to be good things happening across the globe. However, who knows how tariffs play out?
Sure.
In Econ 101, you learn that tariffs are just a tax on the consumer. So are we replacing, taking a tax cut on one side and a tax hike on the other? I don't know. Yeah.
Let's talk earnings for a sec, Charles, from the trading sample, because from what we look at on a day-to-day basis, there's been a few clear things, and a couple of the research firms around the industry have put together a assessment that is basically two parts. One is that the magnitude of swings post-earnings is larger than the last quarter, both for upswings and down. But then there is asymmetry, no doubt, where the ones that miss, the companies that miss, are dropping. I think I saw a report at Morgan Stanley. It was like 1% for the double beats and 3% losses for the double misses on average. What kind of environment does that tell you as a trader?
Yeah, it's pretty apparent how bad stocks are getting punished this year. And it wasn't like that. And this is very similar to, it's funny that you brought up that volatility drop, the huge, risk-off move that we saw in 2015, 2016. We were just talking about it in the room, in the back room, and all of a sudden the market just shot up to all-time highs from those levels. And it just seems that we're not seeing the same type of velocity of risk-off, but it's just that people are segregating their small points. So they're looking at certain small products, whether it's the individual stocks or the sectors themselves, and they're looking to be risk off if things go wrong. And they're looking to put risk on somewhere else. I hear a lot of stories about people sitting on the sidelines holding cash, not wanting to do anything, and that's very sensible. But from what I've seen from the clients that I deal with, that's not the case. They want to put risk on. Yeah. They're looking for opportunities in the short term and in the long term. And when we look at the long-term growth, really, it's difficult. Markets trading, at or near all-time highs after a long extended run, after a huge pullback that we saw, as early as 2015, 2016, really even this year. But, from the 2007, 2008, the market's been pretty steady in its growth, even though that it was just a huge tank job and then we started running up. And it's just people are trying to put risk on. They had huge growth in their portfolio and they're looking to get more out of it.
We were talking a little bit earlier about why this feels a little bit different this time. I just saw one of the stats you put up. It was a great lower third there. It talked about 88% of the EPS have beaten so far.
Yeah, that is a huge beat rate.
That's big. That's bigger than what I can remember in the distant past. But yet, look at VIX today, up to 14.5. We're rotating out of the leaders of the market charge that we've had, particularly last year and a half. There's rotations going on. Yeah, there's a geopolitical, but even that seems to be a little bit on the sidelines right now. So it really feels like we're focusing on markets, we're focusing on earnings, but we just can't seem to get the market going right now. Kind of an interesting take on how we stand this far in the earnings season.
That 88% beat rate is even higher than what Q1 was. And by the way, the year-over-year bottom line growth on pace right now, according to Bloomberg, is 25%. Rav, and last quarter was 24.5 basically. So much for the high watermark stuff. And by the way, Caterpillar raised their guidance today.
Right, and so you can make a fantastic story. In fact, everything we're saying here makes a great story for the rally continuing at some point and so forth. But it brings me to an old trading axiom that I forget where I heard it, but the news is best at the top and worst at the bottom. And you wonder if this is...
I don't know if we're good news or bad news.
I don't know.
This is what we're looking at right now from this quarter. There's the beat rate of 88, even revenue climbing there. But when you're in the trenches, Charles, does it feel like companies are being rewarded for this amount of growth? Even CAT basically undid most of their gains, all of them in fact. It ended 2% lower today. And I thought this was going to be the sort of go-to assessment of whether this quarter was better than last, given everything the CEO said.
Yeah, and to me, it's always going to be about guidance, right? Because the prices are reflective of future growth on the stock company. And the biggest difference was that we had a lot of guidance raised over the last 6 quarters, and now we're starting to see those expectations get tempered. And it kind of leads to what Facebook with Zuckerberg and the CFO.
Right.
Sheryl Sandberg.
That's CEO. But it's what
the whole executive team basically dropped down.
Basically guided
King Buzzkill
down.
Is what they called the CFO.
Right. And I just think that they're just trying to temper expectations because ultimately they are going to have to spend a lot of money. They're in a hot mess. They're going to have to redo a lot of their algorithms that they are making a lot of money on. They're actually pushing harder now on marketing. But in the long-term light, when they really fully incorporate the true valuation of what Instagram can be and what WhatsApp can be and really what Facebook can be, I just think they're just starting to scratch the surface. But for now, they have to temper the expectations because they're going to have to spend a ton.
Sure.
And so, if they have these high-end expectations like they've had the last 6 quarters and they've steadily beat, like outrageously beat, they're not going to be able to maintain that pace. And then all of a sudden we're going to have a $200 stock get down to $80 or $70, and that's going to be devastating.
To bring it full circle, Nirav, a market rather that is obsessed with CapEx and costs, that is another piece of the framework. I'm guessing you would probably argue that tends towards more of a value type of market.
I would. And what we're starting to see is a lot of benefit and a lot of earnings power from companies that have actually been conservative with their CapEx and have been returning money to shareholders and so forth. Mm-hmm. Obviously, the tax cut has helped them significantly. And so we'll see if that plays out over the next few quarters.
Yeah. All right, guys, we got to leave it there. Great conversation. David Wayner, by the way, the CFO, and it's not my words. The Wall Street Journal identified him as Chief Buzzkill, the CFO of Facebook. Great stuff, gentlemen. Scott Connor, Director of Trader Education, as well as Nirav Bhatia, co-managing partner at Forum Financial, and Charles Moon, Senior Market Strategist of Equities at Prosper Trading. Great stuff, guys. Pleasure to have you both here.
Thank you.
Thank you.